Hey guys, it's Stan here. Today we're going to talk about derivatives. So what are derivatives? There are financial instruments, and actually there are two ways you can use them. Either to speculate or to hedge, which means reduce financial risk. In today's video I will not be covering the speculation part of derivatives, but only the hedging part of derivatives. And today we're going to talk about the four products, which are forwards, futures, swaps, and options. So if you are interested with all that stuff, let's get started. Okay, so as I just mentioned, derivatives are financial instruments, and as we are only talking about hedging this time, so reducing financial risk and not about the speculation part, in this case it's going to be a financial instrument to reduce financial risk. So when we look at derivatives, there are two product classes, one which is called lock and the other one which is called option. Inside of these two classes you will find our four products I just described. First of all, in the lock we have forwards, futures and swaps, and on the other side, on the option side, you have option products. So what does it all mean? First of all, let's look at the definitions of the two classes. Let's look at the lock products first. So the definition, I wrote it down here. It's always, for the lock products, it's a contract between two parties that obliges you to buy or sell an underlying asset at a certain price and date. So what does it mean? Sounds super fancy. We will walk through all these with different examples and stuff like that. It's going to be super easy to understand. But now, first of all, let's focus on the definition here. First of all, it's a contract between two parties. Usually it can be more, but let's stick with the two parties here. So a contract means something that is legally binding. So if you enter or if you buy such a product, it means you have signed a contract, so it's a serious thing to consider. Then the most important part here in this definition is that this contract obliges you to do something. That's going to be the big difference with the other product. And in this case, you are obliged to buy or sell. It's going to depend on the side you're going to be in. An underlying asset. So what can be an underlying asset? Last week in my video, I'm gonna link it over there if you're interested in it, I was talking about the different risks, the different financial risks, and I was saying that there were three: commodity risk, foreign exchange risk, so meaning when you're converting one currency into another, and interest rate risk. So these are the three risks that can be an underlying asset. For example, in this case, an underlying asset could be the milk price or the oil price, or interest rate or something like that. So that's an underlying asset, and you need to buy or sell this underlying asset at a certain price and a certain date in the future. So that's very important. Now let's look at the option product. It's going to be exactly the same definition with a very big difference. Here it's going to be a contract between two parties that gives you the option, not the obligation, to buy or sell an underlying asset at a certain price and date. So you can see that between the two derivative product classes, one obliges you, so forwards, futures, swaps oblige you to do something in the future, and on the other side, an option gives you the option, and in this case not the obligation, to do the same thing. So now let's look at the different products and let's walk through it with an example. Okay guys, let's get started with the easiest product to understand, which are forwards. In this case, we are on the left side, and we are talking about the lock products I just mentioned. So I left you the definition here. So here we are entering a contract that obliges us to buy or sell something in the future. So in this case, in my forward, I took the example of a farmer. Let's imagine I'm a farmer and I produce wheat all year long. Usually without any contract here, I am selling, I'm the farmer, my goal is to sell at the highest price. and I'm selling this wheat usually at market price, which varies a lot, to a cereal producer who will convert my wheat into some kind of cereals. His goal is obviously the opposite of mine, which is to buy at the lowest price. Now, obviously, without the contract here, without the forward, we're kind of in a tricky situation because if the price fluctuates a lot, both of these guys have a lot of risk because nobody knows what the wheat price is going to be next year, for example. So they have decided to enter into a contract, a forward contract, to reduce this financial risk for both of them. So let's get started with the example. Let's imagine I'm in June 2020 and I'm signing a forward contract, which means I have decided and I have agreed with my counterparty here that we would lock the price of the wheat for next year. So it's going to be the maturity of the contract will be in 1 year, and we have decided to lock it for $1 per pound in 1 year. So that's the contract. Obviously, I know it's super expensive for wheat, but imagine just for simplicity that it's $1 per pound. Now, in this forward contract, it's pretty simple because both have signed it and both are obliged to do what they have said in the contract. Here, the underlying asset is the wheat price, and we have defined in the contract a price, $1 per pound, and the date, which is going to be in 1 year, so in June 2021. So now let's fast forward for 1 year. Imagine we are in June 2021. What is happening? Well, it's pretty simple. The farmer sells for $1 per pound, no matter the market price. So what you have to understand with all derivatives in general, it's always a bet on the future, but you do it to reduce your uncertainty. In this case, you are saying, okay, the farmer and the cereal producer have agreed for $1 per pound in 1 year. But now let's imagine in June 2021, when the transaction happens, imagine that the market price is $2. What happens if it's $2? Well, the transaction still takes place at $1, but in this case, obviously, the farmer loses a lot of money because he could have, without the contract, he could have sold it for $2, but he's selling it for $1 because he has agreed on this term. So in this case, he's losing. Obviously, if the market price of the wheat is less than $1, imagine 50 cents for example, then the cereal producer loses because he could have bought it cheaper on the market price. But again here, he has decided to enter into a forward contract to make sure that he knows the future prices and reduces his uncertainty. So now let's quickly look at the pros and cons of a forward contract. Pros, it's super flexible because it's not regulated, meaning you cannot buy it on a market. Here you see it's a deal, it's a contract between the farmer and the cereal producer. There is no stock exchange in between, so it's super flexible because both can fix the terms and there is no regulation, there is no standardization that comes into place when it comes to forward. So it's super flexible and interesting when you are dealing directly for such a topic like the wheat price. The problem, obviously, the big con here, is that you have a very big counterparty risk. What is a counterparty risk? Let's imagine I have agreed as a farmer to sell my product for $1 per pound next year. The problem is, if this guy goes bankrupt, first of all, I have produced way too much, so that's my risk. And second of all, I will have to sell it at the market price, so that's going to be my risk, because this guy is out of the picture and no one else would take over his contract in a forward. It's between these two guys and there is nobody else involved. So that's the counterparty risk. So now let's move on to a very similar product, which are the futures. So if you have understood the forwards, it's going to be pretty simple to understand the futures. Basically, it's exactly the same product. The difference is how they are traded, actually. Now let's look at the example. Here again, imagine I have a fuel producer and an airline. Obviously the airline needs some fuel to run their jets. So in a normal case, they are buying fuel at market price. Here again, both parties have a risk. The fuel producer has no clue of the oil price next year, so he still wants to sell at highest price but doesn't know what's going on next year. And the airline obviously wants to buy at lowest price because it's going to have a huge impact on their costs. So here again we are in the same situation as before. The only big difference compared to the forwards is here in the futures it's regulated, meaning the deal and the contract will take place either on a stock exchange or, for example, here at a commodity platform. We are talking about a commodity risk here, so it's going to be a commodity platform where buyers and sellers exchange. So here it's going to be much more regulated and rigid. But here again, same situation. June 2020, we sign a future contract, exactly the same definition as for the forward. And here the idea, both counterparties have decided through this commodity platform to lock $50 per barrel in 1 year. And when we fast forward 1 year, June 2021, the future will mature. And what does it mean? It means that the fuel will be sold for $50 a barrel, no matter the market price. So here again, as you can see, everything is still the same. Losers and winners also are exactly the same as before, depending on the market price. And here the only difference is that we're going through a commodity platform for the exchange. It doesn't seem to be a big difference, but futures and forwards have a big difference because of that. Because when you look at the pros and the cons, the pro here, and we just talked about it in the forward as a con, in this case here you have a low counterparty risk. Because think about what's going on here. If the airline goes bankrupt, there is still some kind of security through the commodity platform. I think the best way to see it is think about Airbnb, for example. Imagine the world without Airbnb. I want to rent a room next year in Croatia, for example, for a week. And I have contacted a host via phone, for example, and asked him, okay, I need this and this and this next year. Can you provide me a room for $50 a night for this period? And he's going to tell you, yes, you sign a contract. It's peer-to-peer. There is no connection in between you. So that would be kind of a forward contract. Now think about the future would be to say, okay, now I have Airbnb. So I can search and I can find a lot of listings, decide. So you're going to have a much larger market, less counterparty risk, and it's going to be much more rigid because once you get into a contract using Airbnb, you will see that there are kind of some policies like refunding and stricter rules and this kind of stuff. So imagine, like, I think the best way to see a forward versus a future is think about booking a room with or without Airbnb. So now let's move on to the next section, which gonna be swaps. Okay guys, now we are switching gears a little bit because the swaps are different products. We are still, it's still a lock product, so we are still locking something for the future, same as for the forwards and for the futures, but it's a different scenario here. So in this case, for swaps, as you can imagine, we are swapping, we are exchanging something against something else. To give you an idea here, talking about the different risks, usually swaps are interesting when it comes to interest rate swaps, meaning and that's the which is called the vanilla swap. That's the most common swap, is to swap from variable interest rates to fixed interest rates. So now let's look at the example. definition is still exactly the same as for the last two products. It's still a contract between two parties, and there is still an obligation involved to buy or sell an underlying asset. In this case, the underlying asset is the interest rate, and still at a certain time and a certain price. So here in this case, usually we are talking about a company versus an investment bank most of the time. And here the goal, the company is the risk averse. That's the company wants to avoid risk, and the investment bank here is risk seeker, which means they are looking for risk to get some fees. So what is happening here? In our case here, the company, their goal is to exchange. They currently have a variable interest rate, and they want to exchange the variable interest rate against the fixed interest rate. So why does a company want to do that? Think about it for a second. Imagine now we all know that the interests are super low, but imagine if you have variable interest rates, it means they will vary over time, and when the central bank decides to step up and put the interests up again, that means that your variable interests will raise again. So you want to avoid that as a company, obviously, and that's why a lot of companies, especially right now, are switching from variable interest rates, which is highly volatile, to fixed interest rates to know what they're getting in the future. So the instrument to do that is a vanilla swap or an interest rate swap. And in this case, what is happening? The company is looking for a counterparty. In this case, it's an investment bank. This is also highly regulated. It all happens on a market. So the company, in this case, once they have agreed, pays a fixed interest rate plus a fee to the bank, and they receive a variable interest rate from the bank. Now we could talk about for hours about how it works exactly mathematically and stuff like that, and you can definitely watch a lot of videos about it. I would make it very short because from my experience it's always the same. The company pays to get certainty in the future, to know exactly what they're getting in. That's why they want fixed interest rates, and that's why they are paying a fee to the investment bank. And the investment bank is paying back variable interest rates. In this situation here, we could do a lot of calculation, but to make a long story short, the company is always losing here compared to the investment bank because they are just the pros, and they could be pros as well, but in this case here, the company just wants to make sure what to pay in the future, and they want a fixed interest rate to reduce their risk. And the bank, who is specialized inside, they are risk seekers, and their goal here is very simple. They want a fee for this kind of service. So let's forget all the calculation about the swaps. In this case, the company is always the loser, if you want, but it can be losing in a good way, meaning you are paying for what you're getting, but you're reducing your uncertainty in the future, which is the goal here for the company. So swaps are very different from the other products and pretty complicated. And when we look at the pros and cons from a company perspective, in this case, and I just explained it, the pro obviously for the company is to switch to known payments in the future. You're going from variable interest rates, which could go up and down in the future, to something you know. And what do you know? You know that in the future you're going to pay a fixed interest rate, for example 3% plus X of fees, and that's going to be in your accounting and in your treasury, and you're going to know, okay, this is how much I owe to the investment bank. The other side here is much more complicated, and I will skip this part because that's not really the name of the game here. The goal of the company here is to pay for certainty. So the con obviously here is the cost, and that's why a lot of companies don't do it, because usually investment banks are charging way too much fees for this kind of scenario. So here again, and same for all the hedging products, it's not a must to hedge. It really depends on your a risk aversion. How much can I afford? How much risk can I afford in the future? How much can I afford to pay for it? That's more the question here with the swaps. Now that we have closed the lock product section, which was forward, futures and swaps, we will move to the option. Now we are moving to the other product category, which are options. The biggest difference, and I mentioned it at the beginning, is in the definition. Actually, the definition looks almost the same, everything is the same, with one big difference. As you now know, all the other products were an obligation to do something in the future. Well, the option gives you the option to do or not to do something in the future. So now let's look at the example here. I have taken the same example I used for the futures, where I was talking about the fuel price. So here, so you will see the difference. In this case here again, we have a fuel producer and we have an airline. The fuel producer wants to get the highest price, the airline wants to get the lowest price, and if there is no hedging involved, the fuel producer will sell at market price, which means that both are at market fluctuation risk. And now, why is it interesting for both to use an option? Because, well, it gives you the option to do or not to do something in the future. So you are super flexible here. Now let's look at the example. Here in this example, let's imagine again I'm in June 2020 and both have agreed on a marketplace, it's very regulated, to sign an option. In this case, imagine it would give the airline the right, and not the obligation, the right to buy at $50 a barrel in 1 year, and they would pay a $2 fee. Because what you have to understand in options and in finance in general, in finance there is no free lunch. What does it mean that there is no free lunch? It means if you want less risk, if you want more options, you pay more. A little bit like with your car. If you want to have a lot of stuff inside your car, you pay more. Same logic here. So what you have to understand, there are two kinds of options. There are call options, which means this is when you are expecting the prices to increase. For example, if the airline is expecting the fuel prices to go up, they will buy a call option. And if the airline is expecting the fuel prices to go down, they will buy a put option. So now let's fast forward again 1 year to June 2021. In this case, there is something you have to understand, which is called the strike price. The strike price is the price at which the option can be exercised. So let's look back here and let's imagine that the market price is above $52. That would mean in this case 52 would be interesting for the airline to exercise the option, because it's what they agreed, 50 plus the $2 fee, which would be 52. So if the market price is higher than that, they are gaining here in this case. So if you want to sum up the options here in pros and cons, if you are buying an option especially, it always gives you, or generally also if you're selling an option, if it always gives you the right and not the obligation to do something, so it's huge flexibility for you. Then there is something else also, and I forgot to mention it. You know in advance your maximum loss. Think about it, when you are here, you know that you have the option but not the obligation to do something, and you know that you're gonna pay a $2 fee. So in any case, when you are not exercising the option, you know that you're gonna lose the fee at least. So that's why you know that the max loss is known from the beginning. On the con, and we talked about it earlier here, since you have more options and more flexibility, you're gonna pay more for an option than for a forward or future. Now that you know all the 4 products in the derivatives, I wanted to tell you that I post once a week every Sunday. So if you're interested in this content, make sure to like this video. Also make sure to subscribe. Next week, a little teaser, I'm gonna talk about my different jobs in corporate finance. Actually, I have worked as a financial analyst, treasury analyst, data analyst, as well as financial consultant. So if you're interested in the pros and cons, and maybe if you're interested in knowing more about the financial world, make sure to stay connected, and see you soon, guys. Thanks for watching.